Hi, everyone. I'm Mani, the founder and CEO of Valur. For many reasons, interest in tax planning has skyrocketed over the past few years. And at the same time, and for many of the same reasons, tax planning strategies, some legitimate, some gimmicks, have proliferated. In this video, we're going to talk about three of the most popular tax planning strategies to help you avoid or reduce capital gains taxes when selling appreciated assets. We'll be talking about charitable remainder trusts, also known as CRTs or CRUTs, opportunity zones, and exchange funds. We'll walk through an overview of each structure and then go through an example of a real life case study to see how these structures compare and what would be the ROI impact. First, let's take a look at one of the most popular strategies, charitable remainder trusts. A charitable remainder trust is a tax-exempt trust that allows you to sell appreciated assets and avoid paying taxes upfront until you take distributions from the trust. This allows you to grow your assets faster because you avoid paying taxes upfront, can reinvest that money on a pre-tax basis, and your assets continue to compound and grow tax-free. It's kind of like a more flexible version of an IRA. A charitable remainder trust distributes income to the trust beneficiaries, typically you and or your family, for either a specified period up to 20 years or the length of you and your family's life. And when that period is over, it donates the remainder, or everything that hasn't been distributed from the trust, to your chosen charity, hence the name Charitable Remainder Trust. Opportunity zones are another way to defer taxes on your capital gains you've recently realized. Investors who have eligible realized capital gains from the sale of stocks, real estate, business interest, or other investments can roll these eligible gains into what's called a qualified opportunity fund. If they do so within 180 days of realizing their gains, they have two tax incentives that are available to them. First, the capital gains that are rolled into this opportunity zone may defer their taxes until the investment in the opportunity zone is sold or the end of 2026, whichever comes first. Second, and potentially more importantly, the investor can save even more by avoiding taxes when they sell their investment in the opportunity zone. If the investor holds the opportunity zone investment for at least 10 years, they can avoid taxes when they sell this opportunity zone investment. Now, another tool to avoid capital gains taxes is called an exchange fund. An exchange fund is very similar to a mutual fund, but instead of contributing cash for ownership of the mutual fund, with an exchange fund, you contribute stock. Because of an exchange fund structure, US tax law allows investors to swap their highly appreciated concentrated stock for shares or ownership in this exchange fund without triggering a capital gains tax. By taking their concentrated stock position of many investors, an exchange fund creates a diversified pool of stocks and allows each individual investor to substitute or replace their own concentrated stock position with a diversified basket of stocks of the same value. Now, critically, this transaction or exchange is not taxed, allowing investors to diversify without paying taxes upfront. So now that you get the high-level overview of how these work, let's walk through an example to understand, in the same scenario, what would be the ROI of each of these different structures? And we're going to look at this on a 10-year post-tax projection. So we're going to take after taxes and any value or money left in these structures after 10 years, we'll discount back to their 10-year values. So let's get started. Let's assume Carlos is a 35-year-old based in California. He has $1 million of appreciated assets with zero cost basis. He expects to pay 35% in long-term capital gains taxes when selling the asset. Regarding growth rates, for the CRT and exchange fund, we're going to assume the assets, similar to the stock market, grow 10% annually before fees, while the opportunity zone would appreciate about 9% annually after fees, in line with historical REIT or real estate investment trust growth. Now, after 10 years, if Carlos had done nothing, none of these three structures, he would expect to have about $1.4 million after taxes. Pretty good. If he used an exchange fund, he would expect to have about $1.6 million, or an additional 16%. Opportunity zone, even better. He'd expect to have $1.8 million in 10 years, or an additional 33% return. Now, with the charitable remainder trust, he would expect to have about $2.2 million, an additional 57% return. Now, as you can see, on an ROI basis, charitable remainder trusts tend to have the highest ROI. This is really driven by two things: their lower cost structure, which enables you to keep more of the assets instead of losing it to fees, and it allows you to defer taxes for a longer time horizon. And simply put, the longer assets can grow tax-free and avoid taxes, the faster they tend to grow. Now, while charitable remainder trusts tend to have the highest ROI and be the most flexible, each structure has its own set of positive and negative trade-offs. Opportunity zones allow you to reduce your taxes after the fact, after you've already realized gains, unlike the other structures. It also gives you exposure to real estate for people interested in that. Exchange funds, on the other hand, give individuals with concentrated public stock positions the ability to diversify seamlessly. Now, there's no one-size-fits-all solution, and the right choice depends on your goals and personal situation. I hope you found this video useful. If you have any comments or questions, please leave them below. Now, a quick word about Valur. We've built a platform to make it simple and seamless for you to access the same wealth building tools and structures that billionaires like Facebook founder Mark Zuckerberg use. We make it easy for you to understand and pick the best strategy, set it up and administer it at a fraction of the cost of competitors. If you have any questions, you can also check out our website at Valur, VALUR.io, to check out our content and learn more. You can also use our easy-to-use calculators where you can see the potential returns for using these structures for yourself, or if you want to go deeper, you can set up a call with one of our trust experts to learn more and answer any questions you have.